Good morning, ladies and gentlemen, and welcome to the ADEPT Technology Group PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all of the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to Chairman Ian Fishwick. Good morning, sir.
Good morning. Good morning, everybody. I mean, to those of you who I've spoken to many times before, it's nice to talk to you again. And to anybody who this is the first time, my name's Ian Fishwick. I founded ADEPT in 2003 and then led the float in 2006. So I was the chief executive for 16 years and I stood down in 2018 to become chairman. Now, in a minute, Phil and John are going to take you through the nitty-gritty of the first half trading results. But what I wanted to do, first of all, really, was do a bit of a scene setter and just chat for a few minutes. And I particularly want to go straight for what I call the elephant in the room. I mean, at the end of the day, we can't hide the fact that our share price is at or around a 7-year low. And many are named, including us. One of the basic questions is, look, you guys have got debt. What's the impact going to be on you when interest rates start to rise? And I think it's only fair that we should try and tackle that question. So what I'm going to do, unusually, is share a conversation that we had internally in a directors' meeting, probably about 7-10 days ago. And it started with me having a chat with John and said, John, you know, I think that people don't understand how relatively little interest rate changes actually impact ADEPT, because I think people either don't know or have forgotten that 7.3 million of our debt is a loan from BGF, which is on a fixed price basis, so it doesn't change. So I then did some 5-packet maths, which I'll share with you now, and then John did the numbers properly, and I said to him, look, if next year the part of the loan that's subject to variable interest rates is about, let's say, 20 million. It's not exactly 20 million, but it'll do for a rough packet for a minute. And let's imagine a ridiculous situation where the Bank of England puts up the interest rates by 3% on the 1st of April. Now, clearly they're not going to do that. They never move interest rates by 3%. I just wanted to get a feel for, you know, what does 3% do? And 3% of 20 million, 600,000. Now, all numbers you've got to put into context. We're a business that's generating about 8 million a year cash flow. So even under that ridiculous scenario, that's only 4 weeks cash flow. So I said to John, if you put the actual detailed Bank of England forecasts into the model, which is something we do on a regular basis, then the impact must be very, very small. And he came back within a few minutes and said, you're absolutely right. It's about 200,000 a year, which is about 2 weeks cash flow. I don't want interest rates to go up. I don't like spending money. But at the end of the day, 2 weeks cash flow is an irritant, not an existential threat. And at the moment, what you've got is, give you an example, our share price implies an EBITDA multiple that's half of our private peers. It's miles out, okay? And I think what we need to do is kind of go back to 2008, because I do worry at times that the corporate memory is only about 10 to 12 years long, and we've started to forget already what happened in 2008. Because I've got a huge deja vu here. You know, M got marked down because people were worried about small businesses. Then the ones with debt got marked down again. And what we said to people, and proved to be right, was you need to look for people who are, 1, profitable, 2, it turns into cash, 3, they've got virtually no capital expenditure, and 4, it's predictable because there's a high recurring element to it. And the way we got that message across last time was by increasing the dividend. Now, you see this morning that we've announced a 2.5p dividend. Now that's for a half year, so that's implying a 5p for the full year. Now, last time we gradually increased it, and what happened over a 10-year period was the share price always resettled at about 3% dividend yield. So let's just have a look at what 5p is at the minute. So 5p on about 120, 115 says we're on a dividend yield of about 4%. Now, if that did correct to 3% as it was used to, that implies a 167p type range. Now, the city likes you to have consistency. And therefore, one of the kind of rules of thumb is you've got a dividend cover of more than 2 or a bit more than 2. When the guys get into the detail, you'll see we're at 4.8. So we're off the scale in terms of dividend cover. So the discussions we'll be having internally every 6 months are, what do you want to do? Do you want to increase the dividend and try and force the share price up with the dividend yield? Or do you want to pay the debt down quicker? Which is not a bad situation to be in. Now, we're going to go through loads and loads of numbers, but if you don't like trying to remember loads of numbers and you want to remember just one, remember the one that I said before. If the Bank of England raises the interest rates in the way that they expect, the impact on ADEPT is 2 weeks cash flow. That's why we're probably a bit more relaxed than you might expect us to be. Right, now for a proper, more detailed update, I'll hand over to Phil. Morning.
Thank you very much, Ian. Much appreciated. It's good to get that explanation. So there's sort of two sides to this, really. There's a brief introduction that I'll give about ADEPT itself, what we do for those who don't know us, and then I'll hand over to John for a more detailed interrogation of the numbers that we've announced at this interim period. But when I spoke to our brokers not long ago, they said just please plant in people's minds 4 key factors around your business and why should people invest in you. Just keep it to 4 simple things. So I'm trying to keep it to 4 simple things as the key message around ADEPT. So firstly, what we do, we're an award-winning managed service provider. 2 years running we've won Comms Business MSP of the Year award, which is no mean feat in an independently judged event. And what we do is we deliver and support and secure our customers' IT. I'll come on to that in more detail. Secondly, as Ian said, predictable revenues and profit. 73% of our revenues are recurring, and our profitability, it's a slight dip in this interims, is 16% EBITDA. Thirdly, as Ian also mentioned, great free cash flow. So one of the key characteristics of our business is we generate a lot of free cash from that EBITDA. So 90% EBITDA, the net debt cash conversion. And then finally, the market we operate in. The market we operate in is huge. Our turnover is around 70, just north of 70 million. And we operate in a market worth 11 billion. So we are absolutely a drop in the ocean. And that marketplace is predicted to grow at about 5% per annum. So being an award-winning player, providing mission-critical solutions to a market worth 11 billion suggests that we have plenty of runway in terms of taking this business forward. So there are 4 things I would love you to remember from this presentation. So going into a bit more detail. So this is a sort of brief introduction to ADEPT for those who don't know us. So when we go talk to our customers, and we have customers both in public and private markets, these are the sorts of conversations we have. There is a budget squeeze. There is an environmental challenge. There is rampant inflation. So there's that drive to do more for less. There is a battle for skills, and those skills are looking to work anywhere and not be tied down to an office. Underpinning that, there's this apprehension and nervousness about technology and being attacked by cyber. And finally, on this slide is the digitization of society. So when you're interacting with businesses, people are interacting increasingly using digital means, and we all do that every day. But expanding on that, technology is increasingly critical to schools. And I'll come on to some initiatives that we're running that really plays into that. Also, BT is switching off the old copper network. So that telephone that you're currently using, which relies on this old-fashioned copper network, BT is switching that off by 2025. And that then drives, all of that then drives the need for innovation, increased bandwidth, and highly resilient networks. We communicate in so many different ways. So we're increasingly communicating using WhatsApp and Teams and social media. So that communication landscape is changing dramatically. And technology is moving to the cloud. People are looking to use the cloud to to service their businesses. And finally, the vertical piece is that healthcare tech. Healthcare tech, if you look at all research, is on the rise. So they're the sorts of conversations that we have with customers. So what our customers want in terms of their technology, they want to be resilient, they want to be agile and adaptive, they want to be successful and engage in a digital way with their customers. They increasingly want to be unified, so not have lots of different systems that all that create complexity. They want to be secure, so they want that IT environment to be secure. And ultimately, because of that competition for expertise, they want to be a great employer with a modern workplace and increasingly to support the ESG demands that we deserve to adhere to. So that's the sort of the dynamic that we're working within. So what do we do? So this is what we do. I've got 340 great people working for the business. We have some phenomenal partners that we really focus on, so that we have a great engagement with those partners, and they bring us opportunities, and we understand and know how to deploy those solutions. And these are the range of services, the family of services that we provide to those customers. So managed network, Wi-Fi, increasingly Wi-Fi in business and in schools. We have a cloud service capability, so we can host applications. We engage with organizations to help them deploy the most effective voice solutions. We deliver that through professional services. We manage people's IT, so I've got a whole range of experts that are either on the end of the phone or in customers' offices and schools to help support their IT. We ensure business continuity through resilience and through the use of technology. We help people move to the public cloud. We've helped several hundred schools adopt public cloud over the last year or so. And as I say, that cybersecurity piece, so having the expertise to deploy all of that, but also really understand how we can protect that technology estate from bad actors. So that's the portfolio of skills that we have and expertise we have and the partners we bring to the market. So then who do we do it for? So we have a whole range of customers. We support some 15,000 sites across the UK. We have some phenomenal references. The Kent NHS, a fantastic relationship where we provide networks for 400 organisations across Kent. We provide technology, telephony technology to the London Borough of Greenwich. We've just undertaken a big network deployment at the Atomic Weapons Establishment. We provide technology to Southhook Liquid Natural Gas platform, which is particularly busy at the moment given the energy crisis. We provide technology to the likes of Sabre, which is a very well-regarded insurance company. We do a whole range of services for Sabre. And as I said in my introduction, we're an award-winning organisation, so we do really know what we do and get recognised for that. And I thought I'd share with you just a bit of a sales tool. So this is, I call it the game board. So my challenge to the salespeople we have in the business is to get organisations talking about the different capabilities that we have and get them to share with us, what's the biggest challenge you face as a business at the moment with your technology. And here's the game board. Here's a collection of potential places on that board. And the great thing is we can apply great references, whether it's HCA or Norwegian Cruise Line or Sabre, as I talked about. The construction testing, we do a whole range of services for construction testing. So we've got some great references and great demonstration of expertise against all of the squares on the game board. So yeah, that's the sort of conversations that our salespeople are having with our customers. And to bring that to life more in a more focused way, the TUC is a fantastic example of where we've deployed a whole range of services. So the TUC came to market with a challenge to streamline their ICT, remove inefficiencies, simplify their supplier landscape, improve connectivity, security, and resilience. So all of the things that we we've talked about on this presentation so far. And we've now, during the course of the last 18 months, taken the TUC on a journey. It started off with IT managed service, and we've rolled into that and moved to the cloud, unified communication. We've deployed security solutions. We've deployed a modest wide area network for them. We've empowered flexible working, and we've done all of that through phenomenal professional services, and we've had a great feedback from the TUC. So hopefully you can see from all of this that the breadth of capability we have, and to sort of summarize, we win in this marketplace. We're successful in this marketplace because we have references, we have strong partnerships, we have a phenomenal culture, and we're committed to our customers. So next, I'd just like to touch on some of the figures that we've shared in the interim statement. So our revenue broadly flat compared to H1 last year, which in the current marketplace, very pleased with that result. Underlying EBITDA slightly down, which is incredibly frustrating as the CEO. I'll leave John to sort of talk about some of the supply chain challenges and the consequence of that. Adjusted earnings per share 12.1p, so again pretty consistent. Reduction of senior debt, which is a big highlight of these results, and I'll let John go into the detail on that. Healthy cash flow, and that dividend increase to 2.5p. So as Ian quite rightly says, we shouldn't be triumphalist around these results. I think we should be proud of the effort that underpins these results. I think they're demonstrating resilience in an interesting and challenging marketplace, and it just shows the strengths that we have within the business to deliver these sort of financial outcomes. Going under the covers on some of that, we have been championing for quite some time this big push around cloud-centric services. It's a key factor of what we do. Every customer that we engage with, cloud is probably one of the first things they'll mention in those conversations. So to see organic growth in cloud-centric revenues was particularly pleasing for me as the CEO. And this long journey that we've been on to move to managed services and away from the structurally declining traditional telephony marketplace, we're in the sort of final stages of that journey. So managed services is everything apart from traditional telephony. Is now 89% of our revenue. So that's a tremendous journey that we've been on over the last 5 years. A little bit about ADEPT Nebula, which is our hybrid cloud platform. We now have 764 services delivered through that platform. So it's a 17% rise in services delivered over the period. So that's a very encouraging growth. So it shows the relevance of that. And securing over 115 new clients during the period, again, very clear evidence that our sales team have a strong story and are able to take that story and turn it into new opportunities. And in the bottom box there, you can see some of the excellent references that we've secured over the last 6 months. Just a couple of very brief slides on strategy, and this is incredibly high level, and I make no apologies for that. It's really important internally and externally that people understand what our key focus is. So when we sit down as a management team, and when we're driving the team, and when we're communicating with 340 people, these are the sorts of conversations that we have with them. So just to remind people of our strategy, focusing on organic growth, it's really important that we capture greater market share. We've got some phenomenal supplier partnerships. They respect what we do. They respect our skills and capabilities. So making sure that we retain customers, we delight customers, we sell more things to customers, and we secure new ones is a key part of our DNA. Second piece is structuring for success. So it's making sure that we have the right technologies, the right structures, the right people in the right places to deliver against that organic growth objective. And also, coalescing around vertical markets. We're very strong in education. We've got great capability in the NHS, and obviously superb expertise in private sector too. So making sure that we have a very strong story to take to those key vertical markets is an important part of what we do. And thirdly, which was, we've had many conversations over years about reducing gearing. So our focus on reducing gearing, being capex light, making sure that we turn that EBITDA to free cash, and great success in that, and more to come. Finally, before I hand over to John, a couple of things on initiatives. So in the second half of this year, we are doing, we signed up in October an alliance with Canon. It took about a year actually of working with Canon to help integrate systems, to help educate the Canon team, to make sure that Canon took to market something that they were incredibly confident in. So incredibly proud of that. I mean, Canon are a global brand, very highly regarded, a tremendous quality organization. So I'm incredibly proud of the fact that they are taking to market Canon IT services powered by ADEPT in the UK. It was a great success for them in Australia and that region. So they're looking to replicate that in the UK, and early signs are very promising. Couple of public sector initiatives that we're again having some early success with. So the Department for Education has set aside £150 million worth of funding to help disadvantaged areas of the UK connect the classroom, so embrace technology. And we've already won some pretty substantial projects in that space, and we'll be looking to double down on that in the second half and beyond. So watch out for news on that. And GP transformation. The NHS have set aside £78 million to help digitally enabled GPs, and they specifically mentioned within that announcement the rollout of cloud-based telephony systems in general practice to improve their engagement with patients. And that was a story that was very prevalent in the pandemic. So we've had success with a solution called Surgery Connect in that space, and we're looking to secure more projects as a result of that support funding. And finally, Sage Intacct. Sage Intacct is a new cloud solution that Sage are bringing to the UK. They've had success with that in the US. I think they've grown their US market by about, or the US business by about 30% on the back of this solution. We want it of only a handful of companies in the UK that are Intacct partners after some months of engagement with Sage. So very hopeful that will bring revenue to the business. So four very specific initiatives that we're running with to support the business going forward. And underpinning that is our general conversation. So when we're engaging with salespeople across the business, or actually support project services, the whole organisation, because everyone in our organisation are salespeople. So leading with consulting, developing that Microsoft expertise, providing innovation around moving data around organisations, wrapping that within security. And we've got this initiative called the Security Continuum that we're going to be announcing over the coming months. Extending into ERPs, our customers want us to deliver that solution as part of a broad range of services. And that focus on partners. Our big drive is to make sure we have a limited number of fantastic partners rather than a proliferation of casual acquaintances, if I can put it that way. Okay, let me hand over to John to go into the detail.
Thanks, Phil. Morning, everybody. My name's John. I'm the CFO of ADEPT and have been for the last 15 years. I'll give you a quick rundown of a bit more detail on the numbers. So looking at how we analyse the business, I mean, this will be no different to any of those of you that saw the presentation at full year end in March. We look at our revenue streams in four principal segments. The one we focus on most is the highest growth area of the business, which is the cloud-centric strategic services element, and that's all of the cloud offerings that we have, be it hybrid cloud, private cloud, public cloud, etc. Any hosting services, voice over IP, and the professional services and consultancy. Then we've got the inevitable technology products, which is hardware and software. These are the one-off sales that we make to the customer base. This is not the primary area of focus for us, because we are principally focused on generating recurring revenue rather than this one-off piece. But inevitably, when you're putting new solutions in to get that recurring revenue, you have to put in the one-off sales. Then we've got the support services piece, supporting the customers through the likes of help desks, first line, second line, and third line support agreements for customers. And then we have the traditional telephony, the fixed line part of our business, which is the shrinking structural part of our business, as we transition more into managed services. We do focus mainly on recurring revenue, so we monitor the recurring versus the one-off proportion, but also that managed service traditional telephony split, following that evolution out of the fixed line sector and into managed services. We also do look at our segmentation by market. We have a good presence in public sector, healthcare and education, currently roughly around a 50-50 split, which gives us some resilience against some sort of macroeconomic factors. Also, looking internally within our business, we've been rolling out and integrating all of our systems over the last couple of years in a project we call Project Fusion, to try and create one ADEPT, and we were looking at the percentage of our employee base using that one ADEPT system. I'm pleased to say that everyone is now using that system, and that project is ostensibly complete. And then also monitoring satisfaction levels, both from a customer perspective and also from staff. Customer retention important to us, but also staff retention. So monitoring things through a Net Promoter Score and the Employee Engagement Survey. So if we go over into the actual numbers, in terms of revenue 34.2 million in the first half, and that's 89% managed service revenue, so up from the prior period at 87%. In terms of managed service recurring, we've seen 3% organic growth in the period, and that's 3% growth in both the cloud services and also support services, both up organically. Within the cloud strategic services, we've seen good growth within cloud and voice over IP telephony, as you'd expect, as we see people transitioning away from fixed line and into IP-based telephony. We've seen about 9% organic growth in there. The other piece of the cloud services that we've seen good growth in is in software licensing, the likes of Microsoft 365, Sage licensing, etc. And we've seen 28% growth in software revenues over the last half year. The one-off revenue from tech products is basically flat at 6.5 million. It's quite a challenging environment for technology product at the moment in terms of hardware and software. The global chip shortage has seen supply chain disruption. And so we've seen an impact of roughly 1.1 million of revenues being pushed out of the first half, and we're expecting to deliver those in the second half, and also some moving out into the following financial year. The fixed line part of the group is the structural decline piece. That shrunk by 17% across the period, and now it is only 11% of group revenue. Not something we focus on, but we have seen an acceleration of business call volume reduction as people are transitioning across to the cloud telephony. As I said earlier, we're focused on recurring revenue, relatively stable. 73% of total revenue comes from recurring services that are being billed to customers month after month. So we've got good revenue visibility across a high proportion of the revenue stream. And even within the 27% of the revenue that's coming from one-off product, over 80% of that is actually coming from our existing supply base. So it's sort of a reoccurring revenue stream. It's existing customers that are refreshing their technology, after a 3 or 5 year period. So, we've got reasonable visibility even on the one-off part of our business. Balanced customer portfolio, 50-50 split between public sector and commercial, and no single customer concentration either. The top 10 customers have actually shrunk as a proportion of total revenue, about 17% of the total, as we start to bring in more customers in that mid-tier that are sub the top 10 customers. EBITDA in the first half is 5.4 million. We have experienced some margin pressures at a gross margin level from a high proportion of low margin hardware and equipment, so the likes of laptops, iPads, etc., which are inherently lower margin. The piece of the business that we've seen in terms of supply chain issues tends to be on the more complex, higher margin product, and so unfortunately that's been pushed out into future periods, but gives us some benefit in the second half and also into next financial year. We've had other challenging operating cost pressure on sort of more macro factors, things like energy pricing going up, salary inflation, increases to the national insurance rate that's subsequently being reversed in half two. But that's been offset by operating cost efficiency, which actually seen a 4.5% reduction to operating costs in the first half compared to the prior year. And that's through the One ADEPT project being largely completed, meaning that we could complete the restructure of the group, moving from 5 operating divisions down to 2, taking out that sort of mid-tier senior management team. In terms of customer employee retention, we have been focusing on an employee rollout of a flexible benefits platform for the benefit of our employees. We're hoping that will yield benefits as we move forward in terms of reducing staff churn. Managed service EBITDA was largely flat at 4.9 million, and that's impacted by the supply chain delays in H1. We haven't seen any current easing of supply chain, but we're hoping by year end we'll start to see an easing of that. Just to scale it, that project backlog for things that are long lead time, the 9 to 12 months lead time, is about 1.1 million and approximately 400k of margin that's been pushed into the second half and into FY24. Generated just under 16% EBITDA margin, so a slight reduction from the 16.7 in the last period, primarily through the operating cost offset didn't quite offset the gross margin reduction. EPS in the first half, 12.1 pence. On the back of that strong cash flow, we've reinstated the interim dividend at 2.5 pence. And against that adjusted fully diluted EPS number, we've got excellent dividend cover, as Ian mentioned earlier, 4.8 times. So, there's plenty of scope there to follow a progressive policy as we move forward. In terms of cash flow and funding, Phil mentioned earlier that we've got these pillars of strategic focus, and one of which is around debt reduction, and we continue to focus on that. In the half year, we've seen a £3 million reduction to debt and earn-out liabilities since March 2022, so that's a 9% reduction. The senior net debt is currently sitting at 30.7 million, and that's after we paid out that 4.3 million earn-out for the Datrix business that we acquired in April 2021. So that earn-out was paid basically all from the free cash flow generated in the period, and there's no further earn-outs due. So, as we move forward, we'll be looking to either return funds to shareholders or use the free cash flow to pay down the debt. The cash conversion percentage remains high. It's always between 80 and 100%. In this period, 91%. We have got a continued focus on customer credit collection, cash focus of the business. CapEx remains low, 1.6% of revenue. We're all about generating that free cash flow and putting it to use. In terms of the overall debt facility, so we're currently using 30.7 million of the debt facility out of a total of 70 million. So we've got plenty of cash headroom within the business. I'll pass back over to you, Phil, for the ESG update.
Thank you, John. So just a very brief one. Obviously COP is on at the moment, and it's really important that we as a business don't shy away from the challenge that we have in terms of reducing our carbon footprint. So we've taken this incredibly seriously. Obviously, that's only one aspect of ESG, but I'll focus on that. Apologies. So we actually undertook a full carbon audit in the summer of this year. We've actually reduced our carbon footprint over the course of the last 12 months by switching to more green energy providers. We're also moving to more energy efficient offices over the course of the next year or so. So there's plans afoot. We have done the full audit. We understand exactly what we need to do, and we have a carbon plan published on our website. Okay, so business outlook. I'll address some of the questions, because obviously it's a shame that we can't sort of do this in an auditorium and field the questions in person. So I'll try and do that using the technology. So I think strategic alliance with Canon. Hopefully, I've covered most of that. What effect does this have on the pipeline? So we're piloting at the moment. We've got a handful of the Canon sales team engaged with us. We've already won 2 opportunities with Canon, with some pretty impressive names, but sadly we can't share them publicly. The Canon sales team is 150 strong in the UK, and the plan is to have all of that 150 sales team talking about IT services alongside what they do as a core business. So early days, but really hopeful we'll see some good revenue coming through on that. And there was a point about margin. So effectively, we don't have the cost of the sales team or the internal sales team, so we're paying away some of that cost of running a sales team to Canon. So it sort of nets out in terms of the cost of the alliance with Canon. The next one was about market growth of 5%, but we've only grown by 3%. So the supply chain is the one that really dents that. We believe if we were doing like an adjusted profit and revenue for the first half, our growth would have been nearer 6%. But obviously, with the supply chain affecting the ability to deliver on some of the orders, then it's been tweaked down to 3%, and that's the reported figure. So I think we're growing. It feels to me as if we're growing in line with market growth, but it's not been seen in the figures because of supply chain. Next one from Alistair about relationship with lenders. How often do we update them? So we produce a report for our lenders once a month, which contains a full breakdown of our performance as a business. And John has regular conversations with them. But the good thing is those conversations are very straightforward. We've got great support from our lenders. They're very comfortable with where we are. We're not hitting up to the buffers of covenants and the like. So, John, I don't know whether you want to add anything to that, but I think we would say we're in our lenders' good books.
Yeah, no, definitely. We update the lenders, as Phil said, in writing about once a month in terms of providing figure updates and commentary around the numbers. In terms of catch up with the relationship directors once a quarter, and it's very straightforward engagement. They're very supportive of the business, and I see no change to that moving forwards. And equally, we're being contacted by other lenders who would like to get involved with the business. So it's an excellent relationship.
Can I just pick up that last point? I mean, because we are constantly pitched by other banks. In this environment, what they're looking for is low risk cash flow. Well, we tick that box massively. So ironically, we become more and more attractive to banks in this environment.
Yeah. So a couple from Dave. So I think I've covered the margin through partnerships. The size of the market, number of competitors, will we get commoditized? I don't believe so. I mean, obviously, what you have in any evolving market is some aspects of your business get commoditized, but then new things come on board, and those new things give you greater margin. And that's the balancing act that we always play as business leaders is identifying where those new opportunities generating greater opportunity and greater margin arise from. So SD-WAN is a good example where more sophisticated solutions solving a bigger problem in a more elegant way, then the margins attached to those solutions are greater than the more commodity point-to-point network solutions. So that's the classic example where the portfolio is evolving and therefore you're moving into a better margin space. So that's the constant question we ask ourselves, and that's why we're an agile business. Then finally, the question from Alistair regarding debt reduction and acquisitions. Are acquisitions off the table given our focus on debt reduction? And yes, they are. Our short to medium term plan is to really focus on driving down that debt, particularly in this current market. It just makes huge sense to just focus on organic growth, structuring for success, driving down that leverage, and we're going to continue to do that in the short to medium term. And that makes huge success. That is a very simple and straightforward strategy that has been very well received. So hopefully that answers the questions that we have in that panel, and you found those pretty straightforward and frank. Business outlook. So finally, business outlook. What do I see? We have a robust business model, 73% recurring revenue, good mix of public and private, which sort of insulates us from some of the headwinds. We are able to capture significant wallet share, and we're hunting for more of that wallet share with the acquisition of Datrix and the SD-WAN solution, and obviously the Sage initiative that we've shared earlier. We're building upon existing capabilities. We know this space, we know what customers are looking to do. We have great references, so we are building upon that capability. Market dynamics do change and drive change. The switch off of the copper network is an opportunity. This drive to cloud is an opportunity. Everything as a service is an opportunity. So there's a whole range of things that we need to just keep talking to our customers about, and as a result of that, we'll capture our share of that £11 billion marketplace that we talked about. People are key. There was a question actually about attracting people in a tough staffing market. We have a very good reputation as an employer. We have a very good organisation. We've adapted that with the flexible benefits launch. So when we're talking to new potential employees, we can talk about a range of benefits as part of our offer to them. We're focusing on training. We undertake employee engagement surveys. We never take our staff for granted. So it's a really important part of our DNA, because without those motivated and inspired people, then we don't have a business. And finally, this simple strategy, we're going to focus on this simple strategy, and for me, that makes huge sense. So hopefully that gives you a little bit of a sense as to where we're focusing in an interesting market.
Phil, just let me add one bit there. I mean, sometimes for investors, it's not that interesting when we say, hey, we've won Managed Service Provider of the Year for 2 years running. But it's really great for the staff. Don't underestimate how good they feel when they can see that their industry peers think that they're good at what they do, right? So those kind of constant awards. I mean, the other day, our billing team won Best Billing Team in the industry. That might not be the most exciting award in the industry. It is if you're in billing, right?
Yeah, absolutely.
Phil, John, Ian, if I may just jump back in there, and thank you very much indeed for your presentation this morning and for answering every single question that came in from investors. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended for you to review, and then add any additional responses where it's appropriate to do so. Phil, perhaps before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Yeah, I think we live in interesting times. I mean, I read an article this morning about 2 black swan events in the space of 3 years, and goodness, that doesn't half make running a business interesting. But I think these results, even given that backdrop, have been, I think, demonstrate the resilience of the business in that situation. There's opportunity out there. The marketplace is huge. We're constantly examining what we take to that market and making sure that we have things that are relevant to our customers, as we've talked about. I think being a public-private business really helps, because we can pull different levers to capture our fair share of that marketplace, and those strong partnerships bring us opportunity and make us relevant. So I think if I were to sort of summarize, resilient trading in an interesting market with a great team and phenomenal capability, and we'll continue to move forward.
Phil, that's great. And John and Ian as well, thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of ADEPT Technology Group PLC, we would like to thank you for attending this morning's presentation, and good morning to you all.